In this month's Economic Update, Kaplan Professionals' Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Michael Pollock, and this month we're speaking to Janu Chan, St George Bank's Senior Economist. Thanks for joining us, Janu.
Thanks for inviting me.
So, Janu, what's the economic outlook for Australia for the remainder of 2015 and into 2016?
Well, Michael, it's probably going to be more of the same as what we've seen over the past few years. Unspectacular growth in 2015 and 2016 is what we're expecting. So we're looking at annual growth of still around a 2 in front for this year and next. It's not as fast as what we would like, but it's still growth nonetheless. And that's the reflection of the challenges that Australia are going through. We are going through a big transition from growth led by mining investment, and that was a big boost to growth earlier. Now that mining investment's coming off, it's starting to be quite a big drag on growth, and so we're going to need to see other sectors of the economy start to do more of that heavy lifting.
Okay, and what are the biggest challenges for the RBA as it attempts to stimulate growth in non-mining areas of the economy?
Well, that is a big challenge for the RBA. It's this transition from mining investment to stimulating growth in other sectors of the economy. But I guess the big challenge for the RBA is that there's only so much it can do. It can lower interest rates and stimulate the economy through that, and it has done that. Interest rates are very low now, and it just needs that, I suppose, time to flow through to the economy. I think the RBA governor has summed this up quite nicely about what a difficult position that they're in. They said they can lead the horse to water, but it can't make it drink. And well, look, funding is very cheap now, but the RBA can't make businesses go out and invest and spend.
What are your thoughts on the likelihood of the RBA cutting rates by the end of the year?
It's not our view at St George that the RBA will cut again. Interest rates are already very low, and I think the RBA is in a position where it can just wait and see how things develop, see how the impact of low interest rates are having on the economy, and wait for that impact to flow through. Plus now the Australian dollar is a lot lower than it was, and that can provide that additional stimulus for the economy. In a way, it has done some of the work for the RBA in providing that support to growth. The other thing is that the labour market is probably in a better position than what the RBA had thought previously. And so I think the RBA is a little bit more comfortable with how things are at this moment.
Where do you expect the Australian dollar to be at the end of the year?
We have seen the Australian dollar fall quite a long way in a short period of time. There's a lot of momentum downwards for the Australian dollar, and it's quite possible we could see the Australian dollar fall a bit further. But a lot of what is driving the currency down now we see as being sentiment driven. A lot of fear about China, there's a lot of uncertainty. I think it depends a lot on how that sentiment evolves, on where the Aussie goes over the next year or two. Our view has been for some time is that, well, there are some challenges in China, and it's got a lot of issues it needs to sort out, but on balance, we think that authorities have in the back of their mind they want growth to be at a certain pace. And they do have the means to get there if they really want to. And so if with these downside risks evolving, the Chinese authorities can provide that stimulus through fiscal means. They can ease monetary policy further. So some of these fears we think in China are perhaps a little bit overdone right now, and we suspect that the Aussie, once these fears subside, the Aussie could be in for a bounce sometime.
So where do you stand on the fall in the Chinese share market being indicative of deeper structural problems within the economy?
I think these are two separate issues. it's hard to tie the two together. We did see that massive fall in the share market, but that's because the share market rose so much earlier on. I mean, you had gains of over 100% at one point. Those sort of gains are just not sustainable and a reflection of the market being relatively immature. I mean, you don't see that sort of thing happening in, say, Australian stock markets. It just doesn't have that array of sophisticated investors in China. So you're going to maybe see these large swings. I think it's a reflection of the difficulties of moving towards a command-based economy towards a market-based economy. That's one thing that they're grappling with. At the same time, the Chinese authorities still want control over everything. And they're also going through a transition from growth led by investment to one led by more consumption. And so that's been a difficult challenge for the authorities to navigate with. They've got a lot of balls to juggle, and I think it's a very challenging time and an uncertain time, but you know, there are those means which can help support the economy.
So further to that, what's your opinion on the level of state intervention in the Chinese market?
It's a very unusual situation that China's in. They do want to move towards a more market-driven forces, market-driven prices in the share market and also the currency. They want to do that. They want to liberalise their financial markets, but they still do want that level of control. They don't want markets to fall too far. They don't want things to be too volatile. I think that's a fair concern. It can be destabilising, and moving from one end to the other is difficult, and to navigate through smoothly is difficult. So I suppose some of measures are warranted, say within the currency markets to help stabilise the currency, but some of the heavy-handed measures in the stock market I think could be counterproductive. If you're limiting the ability to sell, if there's a risk of being prosecuted, then you're going to drive away potential investors, and that's not going to be helpful for the market over the long term.
Just looking at Japan, to what degree is the Japanese economy now on the path to recovery after Abe's Three Arrows program, and what's your outlook there? It's
been a bit of a bumpy road for Japan. If we think back to the Three Arrows strategy, we had monetary stimulus, fiscal stimulus and economic reform. There's probably more that they could do on economic reform. There's limited measures they could do in terms of fiscal policy because their debt levels are so high. So monetary policy has been, I suppose, the most had the most effective in and biggest in scale in what Japan's done. And I think the biggest benefit to the Japanese economy is that it's boosted confidence. We are starting to see prices rise, which means wages are more likely to rise, and they have a little bit. So Japan's in a much better position, I think, than it was, but there are still those concerns for Japan. Population is still shrinking, and at the moment there's probably some global growth concerns too, with China and the US exports are just not holding up as much as they would like, particularly with the yen being quite weak now. So I think that's been a little bit disappointing, but if they have, I think, come a bit of a way from where they were, and if they do get wages picking up, then that improves prospects for household consumption.
So just looking at the US, to what extent has the expectation of an interest rate increase already been factored in by the market?
I don't think that financial markets are fully pricing in a rate increase by the end of the year, but I think with what could occur is that what's going to be more important for financial markets is what the Fed actually says. Even if they do increase interest rates, they could emphasise that the path of tightening is going to be quite gradual. And I think we could be in a scenario where the Fed could hike interest rates and we would see the initial move upwards in the US dollar and bond yields, but then yields in the US dollar could fall thereafter, because if the Fed's talking about a very gradual rate tightening cycle, then markets will be looking forward to what's going to happen at the end of the rest of this year and next year.
We saw US jobs growth drop to a near 7.5-year low in August. Is it now time for the Fed to raise rates, in your opinion?
It definitely supports the case for increasing interest rates now, Michael. We've got an unemployment rate of 5.1%. The US economy is very close to full employment, if not already there. And with that backdrop in mind, it's about time that the Fed does start looking to normalise policy, because if they wait any longer, there is that risk that the Fed could get behind the curve. So the low unemployment rate provides a very strong case for the Fed to raise interest rates now. If they wait any longer, there's a very big risk that the Fed could get behind the curve. Once inflation starts to pick up, it could become quite problematic quite quickly. And the thing is, if the Fed is going to wait for further evidence of inflation picking up and wages picking up, by that time it could be too late for the Fed to be increasing rates at that point.
And what's your outlook for the US economy for the remainder of 2015 and into 2016?
We think that economic growth will probably be around 2 point something for this year and next. It's not as fast as what we've seen in the past, but we think that the US economy is on pretty solid footing. As we've just discussed, the labour market's improved a lot and it is approaching full employment, and in time, stronger labour market means the greater chance of wages increasing, and that improves prospects for household consumption and spending in the economy.
And what's your outlook for the US dollar?
We're expecting the US dollar to appreciate over the course of next year, and that's as the Fed undergoes its tightening cycle. Markets, in our opinion, aren't fully pricing in the possible interest rate hikes it will undergo next year. The Fed has said that it will take a gradual path and a slower path than in previous rate tightening cycles, but we still think that markets are underestimating what the Fed will do.
We saw the ECB implement a $1.1 trillion QE program earlier this year. How successful has that been for the region?
I think the biggest influence the QE has had, the biggest benefit to the region, is that it has improved confidence, and it's doing all the things that you would expect a QE program to do. Interest rates, bond yields are very low, and stock market has increased. We've got a euro currency much lower, so all these things can help to boost the economy, and it is doing all those things now. So what you'd want from a QE program, it is in place.
So what, if any, are the lingering contagion effects of the Greek bailout package and economic reforms?
There are still a lot of underlying issues for the region, and it really comes down to the structural makeup of the Eurozone. It is because they have an integrated monetary system, a single currency, but all these countries are still doing their own thing in terms of economic policy, fiscal policy, and it's just hard to work and hard to integrate. And I mean, they have had some steps into integrating that, but I think the countries now need to consider, well, do they want more Europe and lose some of their sovereignty? Because I think that's the path that they would need to take if they want the European Union to work and have a functional economy. What will most probably happen is that they could continue to muddle through, and we might get some other issue that flares up later on down the track. That's probably the most likely outcome.
So Janu, what do you expect to be the ongoing drivers of growth in Europe?
Germany is probably the big driver of growth, and exports, that seems to be what's helping to prop up the Eurozone now. And I think that's probably why the currency hasn't fallen as much as some had forecast before, because the economy as a whole, while there's still some problems, it's still growing, and its current account's still in surplus. So I think that's going to be the big driver of growth.
Thanks very much for your time today, Janu.
Thanks, Michael. Thanks for having me.